In the realm of dividend investing, it's typically pretty rare to come across a stock that has a history of offering shareholders both a high yield and dividend growth over time. Most high yielders out there will typically pay the exact same dividend for extended periods of time. But in this video, we're going to take a look at some stocks that have provided investors with not only a high dividend yield of over 7%, but also dividend growth over time. Although stocks that already offer high yields don't typically experience too much growth, these companies we're going to take a look at have managed to offer at least a little bit of growth over the years. So with that being said, let's get started. The first company we're going to take a look at is Blackstone Secured Lending Fund, ticker BXSL. They're a business development company whose investment objectives are to generate current income first and to a lesser extent long-term capital appreciation. BXSL seeks to achieve its investment objective primarily through originating loans, equity, and other securities, including syndicated loans of private U.S. companies. The two primary investment types made by this BDC are in first lien senior secured loans and also unitranche loans. It's a relatively new BDC, having been launched back in November of 2021, and it is externally managed by Blackstone. They're one of several large financial companies that have launched their own public BDC in recent years, along with BlackRock, Goldman Sachs, and a handful of others. Since BXSL was launched, they've had a really good track record of dividend growth. Their regular quarterly dividend has grown from 53 cents per share to 77 cents per share. That's roughly a 45.2% increase in less than 2 years. They were paying special dividends for the first few quarters of their existence before deciding to grow their regular distribution. Currently, their stock is offering a dividend yield that's still higher than usual at about 10.7%. As of their most recent quarter, BXSL's current dividend was 123% covered. So up to this point, their dividend has continued to do really well. It looks like this company's been in the habit of growing their dividend twice a year, as you can see by their payout history. Portfolio-wise, Blackstone Secured Lending Fund holds 98.4% senior secured loans, which are the safest kind of debt that BDCs typically hold. They obviously aren't guaranteed to be risk-free, but senior secured loans have much lower default rates than subordinated debt. This BDC holds about as much senior secured debt as another really good business development company, which is Owl Rock Capital Corporation. From a diversification perspective, the largest sectors they invest in are in software, healthcare, and commercial services. No single investment makes up more than 4% of their portfolio, which is pretty good. Despite being a relatively new BDC, it's already grown its portfolio pretty significantly to roughly $9.5 billion. Although this company has been doing great up to this point, the future for them could potentially see less growth in dividends. Roughly 98.8% of their investments are in floating rate debt, which means they earn more income from them if interest rates are high. If interest rates do get sizable cuts this year, that means they'll earn less income from their investment portfolio. Still though, their dividend where it's currently at is still fully covered, and they do have some room for growing it if they choose to. But overall, BXSL has been a really good BDC. Probably the only reason I don't hold it in my portfolio is because I'm already heavily invested in plenty of other business development companies, but I still think Blackstone's BDC is pretty good. The next company we're going to take a look at is Dorchester Minerals, ticker DMLP. This company engages in the acquisition, ownership, and administration of producing and non-producing natural gas and crude oil interests in the United States. Its royalty properties consist of producing and non-producing mineral, royalty, net profits, and leasehold interest in 592 counties and parishes in 28 states. They are a master limited partnership, which you'll need to keep in mind. I just talked in depth on this topic last week, so I won't go over it again. But holding this company does come with special tax considerations that you'll need to keep in mind. They've been operating since 1982, which is a long time for a master limited partnership, considering MLPs have only existed since 1981. If we look at their share price, we can see they've had an excellent amount of growth, even for this kind of company. But in terms of dividends, this company is a little different from others. They haven't gone the entirety of their existence without a dividend cut, but currently their units are paying the highest dividends they've ever issued. The reason for this is pretty well displayed in their current investor presentation. As is the case for some other MLPs, the amount in dividends that DMLP can pay is largely based off oil prices. There's other considerations to keep in mind, as this isn't the case for all MLPs, but usually if oil prices are high, then that means that more money will be generated for the company and thus unit holders. If you look at the LP distribution history, for example, you can see that between 2003 and 2006, the dividends this partnership paid kept growing pretty rapidly. If you then look at the realized commodity prices line chart on the bottom, oil and gas prices also grew during this time. More recently, between 2021 and 2022, prices have been soaring, which explains why they've been able to pay such higher distributions as of recently. This company currently comes with a dividend yield of about 10.5%. From a production perspective, they continue to grow their operations into acquiring more wells. Additionally, they've also been expanding further into their natural gas segment, which has seen the most amount of growth when compared to their oil and gas production. So ultimately, as this company continues to grow, the amount of dividends should remain high as long as oil prices are climbing. The tricky part about investing in some oil companies and royalty trusts is that if you're seeking income first, it sometimes only makes sense to hold these stocks when oil prices are high. I don't know what oil prices will be going down the road, but if you're confident that they'll be high for longer, then a company like Dorchester Minerals might be a worthy consideration for your portfolio. Finally, one more stock we'll take a look at is Innovative Industrial Properties, ticker IIPR. They're a self-advised Maryland corporation focused on the acquisition, ownership, and management of specialized properties leased to experienced, state-licensed operators for their regulated hash facilities. These facilities are mission-critical for their operators as well as located in states that have established regulatory environments. They're internally managed and they were founded back in 2016. IIPR is the first and only publicly traded company on the New York Stock Exchange to provide real estate capital to the regulated pod industry. This is a company that I've discussed once on this channel in the past, back in February of last year, which I dedicated a video to. At the time, Innovative Industrial Properties were facing some issues and I had mixed feelings about this company. Back then, they were only collecting rent from 92% of their clients and several of them were facing financial difficulties. But looking back at some of their more recent results, things appear to be going smoother for them. Their rent collection has grown from 92% to 97%, which is a sizable improvement for them. They have sold a couple of their properties in their portfolio, but they do appear to be on the right track in terms of recovering. The share price performance of IIPR has been a roller coaster, however, as the market still appears to be a little skeptical. Right now, their dividend is currently yielding about 7.8%, which is extremely high for an equity REIT. After taking some time off from growing their dividend, likely from the issues they've been facing, the company recently announced a small increase in their dividend to now $1.82 per quarter. As of the making of this video, this REIT currently has 108 properties across 19 states. Their properties are owned by 29 different companies and they have a weighted average lease term of 14.9 years. This is probably one of the best WALTs I've seen, and I'd say most REITs have a WALT between 8 and 10 years on average. Despite the improvements, I would still consider IIPR to be a higher risk company for a couple of reasons. Due to POP becoming more popular, it's led to an explosive amount of growth in new hash companies, which is going to drive up competition for IIPR's existing clients. Regulatory risk is another issue that's going to be unique for this REIT that you won't see with other types of REITs in different industries. Considering their tenants sell higher quality products, if the economy gets much worse, then consumers will likely turn to cheaper sources for hash or rely on growing their own. It's also a pretty small REIT, so even just a couple of tenants having difficulties paying rent or just a few vacancies can cause big problems, as we've been seeing with this company in the past. But with that being said, that's going to wrap up today's video. There are some options that exist in terms of high dividends and growth, although I would consider all of these companies to be a little higher risk. But yeah, thanks a lot for watching today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.